So, as we've said, all eyes on that Federal Reserve decision tomorrow and the rhetoric. Economists are expecting the Fed will stop, or at least pause, raising interest rates for the first time in 18 months. Let's bring in Yelena, Maleyev, who is KPMG economist, and Kyle Campbell, American banker reporter, to weigh in. Yelena, I want to start with you. The CPI report this morning doesn't seem to have changed anything materially, although one of the things that the Fed reportedly has been watching, those shelter costs, they did not really abate.
That's right. And that is why we do expect that while the pause or the skip that will occur at tomorrow's meeting is very likely, that the rate hike cycle is not over. This is simply because the pause and the skip is simply because the Fed and Powell just want to see what the impacts of this tightening of monetary policy is going to look like in the overall economy. But it's going to take some time for that to really show up in inflation and in those really sticky measures of inflation, especially in that core services, that ex-housing component. And so this is why we're paying very close attention to these numbers, because this rate hiking cycle and this fight against inflation, it's a marathon, not a sprint. And this last mile, getting it from that 4% to about that 2% target, is the hardest part.
What we've heard, Kyle, from so many of the banks over the course of this earnings season is that the consumer is financially healthy, in good condition, and their spending is resilient. Mm-hmm. If you look at these continued figures, how would you classify the consumer? How might the Fed even classify the consumer?
Yeah, I mean, I think the Fed is going to see the consumer as resilient. Mm-hmm. They're going to say the economy is strong. They're probably going to say that the banking system is strong and resilient as well because of that. But I think what's really critical, and probably why a lot of banks are going to be enjoying this slight reprieve, this skip, if you will, is that it does give them a chance to really get their house in order and deal with a lot of the issues that are still going on. I mean, you saw the figures with Zion's Bank. That net interest margin is under a lot of pressure right now because you do have depositors. Maybe they're not fearful like they were in March, but they're really looking around and saying, what are my other options? Like for well over a decade, you could just keep cash in the bank and it was like cash in your wallet. It wasn't really going to change value too much. You weren't going to get paid much for it. But now, even if you're not worried about a bank failing, you're going to be saying, hey, and this is you as an individual, but also you as a corporate treasurer are going to be saying, hey, where can I put this money and how can I put it to work in a better way? So that's a lot for banks to deal with. And I think, while they make sense of what this means in the real economy, they're also going to be saying, what does this make sense? How does this impact us? How are we going to adjust our loan portfolio and sort of readjust our business to try to mitigate that pressure on the net interest margin?
And Yelena, when we talk about whether rates are going to continue to move higher, what that's going to do for the banks and for all of us, right, who are subject to interest rates, there is sort of this increasing discussion recently that we've been having here on the show about what the current biggest driver of inflation is, and sort of this narrative emerging of excuseflation or whatever you want to call it, where it's companies who are sort of taking this as far as it can go with pricing power. When are we going to see that pushback? And is it even something that the Fed can affect?
It is not something that the Fed can affect. And this is one of the reasons why we really are focusing more on that core inflation, especially core ex-housing, because when we looked at margins, especially for energy companies, those have been the strongest over this last period of inflation. And the real concern that we have as economists is that right now we're in still a very favorable year-on-year comparison stage, meaning last year energy prices actually peaked in June. So even next month's inflation data is going to look like things have been cooling overall, simply because of just that favorable comparison. And then we're also really nervous and worried about the housing market, and that home prices are starting to turn around again and go up and actually accelerate potentially in some markets in the country, all of which feeds into this inflation number. All of these are components of inflation that have been disinflationary over the last few months, have been helping us come down from that really high inflation peak earlier last year. And those are potentially going to reverse course and start to reaccelerate, while that sticky component, that core services ex housing, does not budge downwards. And that means that the Fed has even more work cut out for them and even more potential rate hikes past July's meeting.
Okay, so that starts to get to the question that I was about to follow up with there, Yelena, because what does this signal for the activity that the Fed has to take? What arrow do they have in their figurative quiver, if you will, to deploy up against even the wages that have continued to be essentially, in some cases, passed through to consumers in the prices that they're paying for goods and services?
Right. Monetary policy is a blunt tool, so it's not very necessarily the best tool to use at a time where a lot of these inflationary pressures are actually coming from the supply side of the equation. The Federal Reserve can hammer demand. They can bring down demand for goods, for automobiles, even for housing through, very high now mortgage rates, but they can't fix supply. They can't increase the labor supply, especially in the areas of the economy that are still struggling to find workers, hospitality and healthcare, just to name a few, construction as well. And so they have this very blunt tool that they're trying to use to bring down demand to meet supply in a very supply constrained world. But it's up to other areas in the economy, specifically banks that are issuing credit to really let that credit tightening flow through to the end consumer, so that we do finally have that pullback in demand, not to deep freeze the economy, but just to cool it down a little bit so that prices can come back down to that 2% target.
Well, Kyle, what do we know about what's happening on that front? Sort of where are we in that credit tightening cycle? What are we hearing from the banks right now?
Yeah, it's a great question. There's definitely a tightening of credit, and that's by design, of course. That's what the Fed has been trying to do by raising rates. And we aren't really sure exactly where we are in that life cycle. It's going to sort of, you'll feel it when it hits sort of type environment. So I think we're going to see a lot of banks pulling back if they haven't already. And again, like I said, trying to think about how they want to adjust their loan portfolios, right? Because when you have an outflow of deposits, or even if you are keeping your same level of deposits, you're having to pay more for them. So you have sort of two options as a bank. You can either stay put, not grow, not take on more risk, or you can, try to, I guess, take the pain now, maybe raise more capital, and then start to grow the book and maybe sort of capture some of these higher rates in that loan portfolio. So yeah, it still is we're kind of moving in the dark a little bit as to where we actually are, but we're seeing signs of tightness early signs of tightness in the credit cycle, and we'll sort of see how that plays out moving forward.
And just lastly here, we'd love to get both of your reactions to this, both Yelena and Kyle here. But Kyle, as we think about the financial conditions and who this is impacting in this near term, for small businesses, for some of the investors, we had the Shark Tank, Mr. Wonderful himself, saying that for some of the small businesses he invests in, that it's essentially dried up. There is no lending or funding that they can access into capital from banks with. So what would you define? How would you define that access to capital for small businesses right now? Yeah,
I mean, it's going to be tough, because that's going to be one of the areas where, again, if you're a bank, you don't want to be taking a lot of risk right now. Sometimes smaller businesses are more risky. You want to and this is sort of where you have this sort of bifurcation of the banking system, right? And if you're a smaller community bank, you might be more comfortable to lend to a small business in this environment, because the fundamentals, the people better. Larger banks are going to, they have their business lines, and they're going to sort of stick with those bigger businesses. The middle is where we saw the pressure earlier this year. That's where we're going to continue to see pressure going forward.
Yelena, wanted to give you a chance to respond to that too.
Thank you. Small businesses have been essentially the engine of growth in our economy, especially since the COVID recovery. We're still seeing very high number of applications to form a business, and these are the types of businesses that are likely to hire, as well as really elevated job openings numbers are still in the economy, especially from those businesses with 250 workers or fewer. And so this is where actually this will be difficult for those small businesses when it comes to access to credit. But this is actually one of those silver linings where we could find this immaculate disinflation. If smaller businesses just come back down to those 2019 levels of hiring and formation, and then are able to no longer need to really increase their wages and prices in order to compete in the market, we could actually have that disinflation and cooling of inflation in the economy without necessarily a recession occurring.
Thanks to you both. Appreciate you being here. Yelena Maleyev, who is KPMG economist, and Kyle Campbell, American Banker reporter. Thanks.
Thank you.
Thank you.